What's up, guys? This is Casey, and welcome back to the channel. So we have quite a bit to break down today. We have Tesla earnings that took place after hours that we need to break down and discuss and determine what that means for Tesla and for the markets. And then we also have to discuss what Chairman Powell discussed with the FOMC announcement today with raising rates and also decreasing the books for the Federal Reserve. So let's just kind of hop right into this. So Tesla reported after earnings today, and as you guys can see, they absolutely demolished the earnings. So even in the most optimistic earnings reports on investors, they basically blew those reports out of the water, blew the earnings. So they beat earnings, they beat revenue. They just basically did a phenomenal job in terms of what they were expecting to do. So they brought in $2.52 per share when the most optimistic analysts expected 236. They also brought in $17.72 billion instead of the $16.57 billion. I mean, can you imagine analysts saying, hey, we expect you to make $16 billion, $16.5 billion. And then Tesla says, no, how about we give you 17 points? How about we beat you by over $1 billion? I mean, they just demolished the earnings reports. But what they did not demolish, which we anticipated, was Elon Musk in the report meeting today after hours stated that they are anticipating having some supply chain issues for the first quarter of 2022. Surprise, surprise. Now, the reason this is important is because come earnings time, if you guys are ever wondering why stock goes up or down, a lot of professional investors and hedge funds, they look for forward outlook to determine whether or not a stock should go up or down. You think that would be counterintuitive that it should be the earnings previously, but it isn't. And so because Elon Musk stated that he expects there to be some supply chain issues, that means that he's not anticipating meeting the earnings expectations for the first quarter of 2022. So there you have it for that. But what did that do exactly in terms of their stock? Let's take a quick look at their stock. We are going to discuss the SPY today as well, but I want to go right to Tesla first to take a look and see what their earnings reports did for the stock. As you guys can see here, it pretty much really didn't do too much. As a matter of fact, it's actually down a little bit after hours, and that's just pretty much because of the forward outlook earnings report. And so overall, it's not down too much. If you take a look at the overall daily chart, Tesla's been pulling back consistently in this sideways but downward trending pattern, which I actually anticipate is going to continue, but just purely because of the overall market. So what do we know? We know that Tesla crushed earnings. We know they're making tons of money, and we know that their revenue continues to go up every single year. Tesla is crushing it. And outside of there being, heaven forbid, a recession, they're going to continue to crush it. So Tesla is a great buy at any price, particularly any kind of pullbacks 20% or more. Now, the second thing that happened today was the Federal Reserve Chairman Powell announced today what we pretty much already thought, that they are going to be raising rates in March. Now, what makes this very interesting is that the investors and analysts were hoping that the rates were actually going to be raised in the second quarter, but Chairman Powell mentioned that he is concerned that because inflation is getting very rampant, that it's getting very out of control, that he wants to accelerate the buybacks of the bonds, and also he wants to increase the interest rates. And so the first interest rate hike is going to be in March. Now, the reason that is important is because when it comes to raising the interest rates, that typically comes down to how much the Federal Reserve and how much the banks have to pay the Federal Reserve in order to borrow money. Now, the reason that's important is because that is the prime rate that large banks, like big firms like Wells Fargo and Goldman Sachs and so forth, that's the rate that they pay other banks to borrow money from each other. And then when you want to go borrow money to purchase a car, a house, personal loan, where have you, then they tack on whatever the rate is based on your credit report and risk assessment of your profile on top of that prime rate. And so it just generally makes borrowing money expensive for everyone. Now, of course, we all know that inflation has been ridiculous. It's actually like 7-8% right now, and something that it might even be higher. And so because of that, Chairman Powell today announced that, yes, they are going to be raising the interest rates in the first quarter. And so come March, we're going to probably get a quarter of a basis point, which is basically 0.25%, 0.25, which is basically a quarter of a percent on the prime rate. and then of course that's going to get passed down. There's also a lot of concerns right now with inflation really taking a lot of hit on the housing market and also the food market. I just recently saw a story yesterday that stated that Oscar Mayer is going to be raising the cost for their bacon and for their their very low cost food up to 30%. And they said that it's as a result of inflation. Now, is it completely inflation? Of course it isn't. I mean, 30% price increase, like it doesn't sound like a lot, but when you think of the fact that they sell millions upon millions of pounds and dollars worth of this, Oscar Myers food and product, then that's going to count to, who knows, another 40, $50 million, depending on, how many items that they sell. So that's a big deal. Inflation's been 7% if you count this year, then previous the last year. So we're looking at maybe 10, 12% over the past few years. And Oscar Mayer is going to be raising their foods, 15, 20, 30%. So things are going up. They're going up. They're going up significantly. Housing market. I'm down here in the state of Texas. Housing market has been insane. So much so to where you have large investors and you have large institutions and hedge funds that have now gotten into the individual home buying market, and that is what's really driving the housing market right now. So much so to where new builders such as D.R. Horton and Gehan they stated at some point that they weren't even going to allow investors because they were buying everything up. So imagine, competing against trying to buy a new home or a new townhouse or a new condo against a hedge fund or investment real estate firm that has hundreds of millions of dollars in cash at their disposal. You can't win. And so for a large period of time down here in Texas, the builders stopped that. They did not allow investors to purchase additional single family homes because they were just buying them up. And so Chairman Powell, he recognizes that and he said, hey, it's time to, take the alcohol from the punch bowl. You guys have been punch drunk. And so almost exactly to 2 years to the day that they announced that they were going to have monetary loosening, they now are announcing that they're going to be having tightening. And so we're going to have a higher interest rates come March, probably going to have another rate hike in 3 months from that, and then another rate hike. And then in addition to that, the Federal Reserve announced that they are reducing their buybacks. And so they are now taking money out of the supply system in addition to raising the interest rates for banks and the borrowing. So we're going to have quite a bit of, volatility in the markets. And if you guys if we take a look here at the markets, that is exactly what we are seeing. So go back into November. This is when Chairman Powell actually initially stated around here that he was going to start tightening. And then you take a look here, had nice little pullback. We had a continuation of trying to continue that pattern. And now, starting the new year, we have had a sell-off. And now that Chairman Powell has announced and confirmed that, yes, we are raising hikes and we are continuing the reduction of the buybacks of the bonds, they are basically, tightening their books right now. We're seeing a sell-off in the markets. And we did anticipate this happening, but not so soon. We were thinking, we as in investors and large investors, and we're thinking that this is going to happen basically in the second quarter. But no, not going to happen. So sometime in June, not going to happen. It's actually happening in March. And they're saying that because they're so concerned about the inflation rate. And so here we are right now. The market is pulling off. Let's take a look at some very major support levels to see exactly just how far we think this may go. Well, as you guys can see, if we go all the way back until the start of the pandemic, when the Federal Reserve announced that they were going to be pumping in a lot of money and reducing interest rates, the market has just gone straight up. It tested the 20-day on the weekly, and then it just continues straight up again, and it just has not looked back in a straight line. And now we finally have a pullback. Now here's the concern. The concern is that the Federal Reserve is going to raise rates too aggressively. They're going to reduce the budget too aggressively, and then they're going to basically systematically cause a crash. I do not believe that is the Federal Reserve's intention. It's silly to do that because then they would have to turn right around and then put more money to the economy, which is what they're trying to take out in the first place. So it's a constant balancing act, and I wouldn't want his position because it's extremely difficult. With that said, they have to do something. And so they say, hey, there's all this free money. All these investors have been making tons of money. So, we've been cutting out checks. Although the pandemic is not going anywhere and that it's still, at the forefront of everyone's minds and concerns on a daily basis. In terms of the markets, things have just been over hot for too long. And so, if the Federal Reserve did not step in, as I mentioned in my last video, the price a gallon of milk would probably be $15 in a couple of years. So imagine what the price of housing would be, right? Or the price of cars, things of that nature. So they had to do it. And so in terms of falling down, assuming that we do not, get into an R word, which is a recession, you have to think that we have to be good for at least another 10%. So the highs for the SPY is 479. So let's just say 480. So basically 440 ish would be 10%, which we're past that, right? We're now at the 421. So we're like 15%, right? If we get down to say the fourth, somewhere around here, 410, 415, then we're kind of playing with 20%, which is correction territory. I do think we are going to hit this. I think it's a no-brainer. I think it's not even close. The amount of money that's into this economy right now is just insane. The Federal Reserve said they're going to reduce it, and they're doing it now. And so I'm thinking that we may have a test of actually 342. And I know that sounds really crazy, but the reason I say this is because what you'll notice that stocks are getting crushed in the earnings. So yes, Netflix, right? The industry leader in streaming, they said that they were going to, they're having a reduction in subscriber growth. Yeah, okay, we get it. Not a surprise. But to go from $700 to $363, that's a little over the top if you ask me. Let's take a look at Amazon. Amazon, $37.73. It's now down to $27.70, 27, what are we, $27.86, $27.77. I mean, stocks are pulling back. Even, let's say, Apple. Apple is pulling back and it's touching again. Let's take a look at Microsoft. Microsoft had phenomenal earnings. They had great earnings. They also did, I believe. As a matter of fact, Microsoft had positive forward outlook guidance, but look what happened. It sold off. And so last year, because all the Federal Reserve was pumping in money, these companies were having okay earnings or even good earnings, and it didn't matter what their earnings were. Stock was going up. And now the opposite is taking effect. It doesn't matter what the earnings are, stocks are going down. Apple is set to report their earnings here in a little while. I anticipate we're going to have the same thing. Whether or not they have, I think they're going to blow earnings out of the water. I think they're going to have very conservative forward outlook earnings, and I think that the stock is going to sell off. I just do. I think Tesla's going to continue to sell off. And overall, I think the market should. So if you guys are in any kind of growth stocks right now, like Shopify, or if you're on Twitter, any kind of growth stocks, then I know your portfolio is just getting hammered right now. You're probably down 30, 40, 50%. If you are, I highly encourage you to not panic. This is something that we always see when stocks and when institutions are deleveraging. They start with the growth stocks. The growth stocks are the stocks that make the most amount of money in a bull market, and they are the stocks that get hit the hardest in a non-bull market, which is we are at the very end of that, and that's now starting to deleverage. So don't panic. This may take another year or so before, let's say, stocks like, let's say Shopify, if you will, before stocks like Shopify start to rebound, right? Which has just been getting hammered from 1,100 all the way down to, what am I saying, 1,100? Let's try that again. Getting hammered from 22 all the way down to $1,000. Over 50% loss. Or let's take a look at Twitter for another example, right? So I'm actually in Twitter, and I am significantly upside down, and I'm not selling a single share because Twitter isn't going anywhere, and there's not a replacement. So if you guys are in stocks that are in the industry leaders, even if they're growth stocks, I highly encourage you to hold, to not sell if you can. At some point, these stocks are going to rebound. It may not happen this year. It may happen next year in 2023, but they are. And when they do, they're going to be the industry leaders in terms of growth, 200, 300, 400%. That's just the nature of the beast. So overall, guys, I really hope you guys enjoyed this video. Overall, I think let's stay very conservative, but stay relatively optimistic about the markets. I do think we're going to have a pullback. We'll continue to see this, I think, for at least the next 2 or 3 months until the Federal Reserve is done deleveraging their books, and until we continue to see, I should say, stability in the interest rates. But overall, if you guys are seeing stocks that you like, that you want to buy, you want to get some Twitter here, I don't blame you. You want to buy some Shopify? Not a problem. I do have my eye on Apple. I'm waiting for the behemoth, largest stock on the planet, market cap wise, to come down here some. Where exactly, I haven't exactly determined, but I think this 138 range that I think it will eventually get you over the next few months will be a great buy. And so I would be looking to get Apple here as it continues to sell off, and as we have additional information that occurs in the news or on the markets, I would make a video. So if you guys haven't already, make sure you like and subscribe to the video. Also, leave a comment below. I want to know what kind of stocks you guys have been looking to buy that you have on your watch list. Are you guys looking to get some Apple? Have you made some buys on some Amazon? Are you looking to get some QQQs, which has been, relatively weak as well? What's on you guys' radar on that you'd like to own? And if you have any questions, or if you want, in terms of what to purchase, or whether I think it'd be a good buy, leave a question below and I'll be happy to answer. Other than that, thanks for tuning in, and I'll talk to you guys later. Take care.